Good evening, everyone. Thank you for joining us this evening on Use CFD to Define Your Trading Edge. I'm Crystal, the Community Manager at ProsperUs. Let me introduce our speaker for tonight. Joining us tonight, we have Leries Goh, Director of Leverage Products, CFD team from CGS-CIMB Securities. She has more than 14 years of extensive experience in various financial products, inclusive of equities, CFDs, futures, and Forex. She has also obtained a Chinese language and literature degree from Beijing Normal University and trained in marketing and business management. ProsperUs is a digital investment service catered for the millennials. We aim to provide you with the best-in-class service and to allow millennials to gain more insights on investing. We have specially curated webinars series. So with ProsperUs, you will not only learn how to invest, but also enjoy curated lifestyles at the same time. Check out our ProsperUs app on Google Play and App Store today to start investing on the go. Follow us on our social media like Instagram or Telegram to keep yourselves updated on the latest news. So without further ado, let me hand over to Leries to start tonight's session. Leries, over to you.
Thank you, Crystal. Okay, can you see my slide?
Yep.
Okay, so good evening, everybody. My name is Leries. I'm from the CGS-CFD department, CGS-CIMB CFD department. All right, so very glad that you guys are here with me today. So I think the objective of this webinar basically is to share information with everyone. I mean, I'm sure many of you have heard of CFD before, right? But maybe today we'll just go deeper into the understanding of CFD, the basics of it, and then what are the things that to look out for. Okay, and along the way, I mean, of course, if you have any question, feel free to ask, right? I'll try my best to answer any questions that you may have, all right? So before I proceed, please take a look at the disclaimer. I mean, in the later slides, probably I will touch on certain counters or, just for example. So that's not a recommendation to buy or sell, right? It's just an example for information sharing. So I'm sure at this stage, a lot of people are confused about the market because even the fundamental of the market is changing every day, right? The volatility in the market is tremendous, So, but to a lot of people, it's risky, but to the common man, yes, to them it's risk and then they will stay away from the market. But to a lot of people, especially to the wise, a risk is actually an opportunity for them in fact, just like the Chinese saying, we say 危险就有机会. Yeah, so in the market itself, I mean, for people that are savvy, they know what are the tools available in the market and they can use it, to their advantage. They are able to reap the benefits from the market in times of volatility. But of course, do take note that, especially at this point of time with heightened volatility and all that, it's very important that everyone can stay nimble, selective, and of course, best is to have a diversified portfolio because, like I said, even the fundamental of the market is changing day by day. Okay, and the topic today is how to gain an edge in the market using CFD. But before we go into the points, the different points, so I want to elaborate a little bit of the history of CFD first. Okay, like I said, CFD is no stranger to a lot of people. It's in the market for a long time. In fact, it's believed to have been created in early 1990s, okay, for hedging purpose by the institution, investors and all. Okay, they have a large pool of cash positions, exposure in the market. They need to have some sort of derivative to hedge the position. Okay, and in the late 1990s, then you see a rise in online trading, and then CFDs were introduced to retail traders by different brokers, okay, as a new investing tool. And from there on, you can see that CFD actually started to become popular in many countries. First of all, it started from UK, and then slowly it moved on to other countries and became very popular in countries like Australia or even Singapore and many more. And Singapore started CFD trading around 2007, so from then till now is about like 15 years history. So what is CFD, which is contract for difference, right? It is essentially an agreement traded between yourself, a client, and the broking house. Okay, so what you gain of it is actually the differential between the opening price and the closing price of the contract. Okay, it's a very simple and basic understanding of CFD itself. Okay, and in fact, it allows traders to take advantage of the asset underlying price without owning the physical ownership of the underlying asset. Okay, and CFD can be traded on many different assets, including equities, index, commodity, FX futures, and even bond. Okay, and CFD is a very flexible and simple investment tool. Okay, it can be used to complement your trading strategies. I mean, there are many ways and advantage of CFD. First of all, is leverage. Everybody knows CFD for its leverage factor. Okay, so essentially, CFD itself is trading on margin basis. So if you want to buy, let's say, a counter, for example, Facebook, okay, instead of buying 100,000 worth of value in traditional trading, meaning cash, let's say you are using a cash account to buy a Facebook worth of 100,000, you need to put up 100,000 worth of money to pick up the shares, okay, and settle by T+2. But for CFD, well, you just need to put up a fractional amount. So that is what we call initial margin. So long you have that sufficient initial margin in your CFD account, you can initiate the position of 100,000 with a smaller initial capital. Okay, so for example, let's say, as you can see on the slide itself, is C Limited chart that I'm pulling up here. So this chart actually is just, I said, for illustration purpose. It's taken on 24th of February. Okay, I mean, many of you know about this company. Okay, even Temasek invested in this company as well. So like our Shopee, you know, the e-commerce platform and all that is part of their underlying business. Okay, so as you can see, in 2021, it has a tremendous run. It was up like 150%, you know, in just actually, in fact, it's 300% in 1.5 year time. Okay, but of course, you know, with all this the tech crackdown, you know, and all these restrictions from different countries, you know, so all the tech sectors has been beaten down. And in fact, just yesterday itself, C Limited has gone down like more than 13% because you know, they had a very bad disappointing earnings report out yesterday, and also of course they have some government action, you know, in India and all that affected their result. So what happened is that you can see, you know, it has been beaten down quite a fair bit from the peak. Okay, but based on the analysts, you know, ratings and all that, of course, like I said, this was taken few days back. So whether is there any newer price target or not, please do your homework and then do your research before, you know, you take any action on it. Like I said, this is just for sharing purpose, for information. So let's say, you know, based on the research or the homework that you have done, you think that, okay, I mean, C Limited has come to a level which is reasonable in terms of valuation, right? And also there is a decent upside based on the analysis by various analysts and all. So I would like to take a long position on C Limited itself, okay? But, you know, in terms of capital, I may have limited capital. So I can choose, you know, to use CFD as an option because it provides leverage. So for example, different stocks has got different initial margin, meaning the initial capital that you put in, it varies. Okay, how it varies is one, this is based on the framework, the risk parameter that's determined by the company, and also under the MAS regulation, right? Different counters has got different margin requirement framework. So in Singapore itself, because we are governed by MAS, Monetary of Singapore, so basically for stocks that are within the index component stocks, right, their margin at minimum 10%. Okay, meaning if it's margin at 10%, you will have a leverage of up to 10 times. Okay, but if the stocks is not within the index component, right, the initial margin will be minimum 20%. Okay, so the leverage is up to five times, but not every stock is 5 times. It really depends on what stock you're trading. So normally, whenever you pull out an order ticket on your CFD platform, you will see what is the initial margin required stated there. So it's very clear cut. Okay. And back to this example that I was saying just now, C Limited, if I find that, it's good enough, this price, I would like to get in and buy some. Okay, I pull out an order ticket on C Limited. Okay, as you can see the ticker code here. The initial margin shown is 20%. Okay, US shares, every lot size is 1 shares. So I would like to buy 100 shares. Okay, I key in the number of shares, the limit, the price that I want, and then it shows the total value. If I do not have leverage, I have to pay up this full amount, 11,860, to buy 100 shares of C Limited at this price. Okay, but because I'm using CFD, it provides me leverage. So I need to have 20% in my account, which is 2372 US dollars, before I can initiate this position. Okay, so long I have this amount, I can just click buy, and I will have a position of 100 shares of C Limited in my account. Okay, so long the price of C Limited goes up, and then when I close the position, that is the profit that I make from the position itself. But of course, if the market continue to tumble down and then the price go down, in fact, then I will have a loss on this position itself. So it's very similar like traditional share trading. You think that the share price is going up, you can buy and wait till it goes up, you take profit on it. And you think that the price is going down, for CFD, you have the flexibility whereby you can short sell first. And then when the price goes down, then you buy back at a lower price and make the differential from there as well. Okay, so this is an example of how you use leverage. Okay, and you can see the effect of leverage here. So imagine, I have only a capital of 20,000. In cash market itself, let's say in this example, I have 20,000 and I want to buy a shares of $20. Okay, maximum number of shares I can buy is up to 1,000 shares. The contract value, which is 20,000. Okay, I mean, of course, in this scenario, I'm just taking the rough figure without calculating the commission and all. All right. So if the price goes up by $1, okay, I bought at $20 and I sold at 21, right? My gross profit itself is $1,000. So the ROI is 5%. So in the second scenario, whereby if I also only have 20,000, but I'm using CFD, okay, because I want to have some leverage, okay, to enhance my return. So the same thing, I have 20,000 capital, but in this case, let's say this shares is margin at 10%, meaning I've got 10 times leverage, all right? So in this case now, my 20,000, I can buy up to 10,000 shares in CFD with a contract value of 200,000, okay? So the same thing, if my profit is up by $1, my gross profit now is $10,000 in fact, because the position size is 10 times more with the leverage given. So my ROI, then it turns out to be 50%. But of course, like I said, this is just a very simplistic example, okay? And this is to show you the effect of leverage. And on the same note, of course, if it goes the wrong way, your losses will be magnified as well. Okay, so do take note. It's very similar to cash trading. The way it works, that's why it's simple, because this is almost the same way as how you trade shares. Okay, it's very simple, and how it works is more or less the same. Okay, but the only thing you must take note is that the leverage effect, it can magnify your return, but on the downside, you got to take note that you must have proper risk management in order not to go into the loss. Okay, so that's one. And second thing is, because I've got limited capital, okay, the example given earlier, I only have $20,000. So for cash market, I can buy only 1,000 shares and that's it. I use up all my capital. But for CFD, I can buy up to 10 times of it. But instead of putting the whole lot into buying 200,000 worth of position, now I can use the same capital, I can diversify, right? I can buy into the position of different counters or even different region. Okay, so at least if something happened to company A, my company B probably it will not be that badly hit. So in a way, it diversify my risk, or even different geographical area, right? So, or maybe if the same capital, you can buy a bit of, let's say you want to long, at one stage, people like to long Samsung, and then they want to short Apple, the similar stock. For example, there are so many kind of strategy that you can use, but most importantly is that so long you have enough capital, then you can diversify, and then you can use different strategy in order to, make it more effective for you, I would say. And for CFD, the nature of CFD is that it's very flexible. So you can actually go long or short easily as well. Okay, unlike a traditional cash market. So if you want to go short, meaning when you want to sell the shares before owning it first, in cash market, is actually a very risky thing to do. Okay, so it's never encouraged to do that in cash market. You must definitely should have a SBL account and all that first. You need to borrow the shares first before you go short. Because if, the shares get halted, you didn't manage to buy back your shares end of day, you are considered naked. And then, there will be consequences whereby you're going to do buy-in or eventually lead to, some losses or charges, like fine kind of thing, if you don't buy back. So never do that in cash market. But in CFD itself, if you think that, the market is tumbling, like I said, nowadays, especially this couple of weeks, anything can happen anytime. So if you think that opportunity comes and you want to go short, okay, to take advantage of the downside of the market, you can just go to a CFD platform, open up an order ticket, depending on what counter you are looking at, or even you can look at an index instead. Let's say you have no idea which counter, which company that you think will go down. So you can actually take a short view on a market instead. So you can short sell an index of a certain country. Okay, so for example, we know that recently with all these issues, war breaking out, or there are many other reasons the share price can go down as well. So these are just some of the reasons, but of course, this is more for aggressive traders where they know what to do, and then they are savvy enough to know that, the price go down at what level. Sometimes the price goes down. It goes down fast and furious, much faster compared to rising up. Okay, so if you want to just take a short position on the share itself, like I said, definitely you need to do your homework. You understand how it works, and then at what stage you want to buy back. If it doesn't go your way, you must also set a stop loss and all that. Okay, so the share price can go down based on many reasons. Okay, so this is not exhaustive, but like I said, these are the reasons may contribute to the downside of the share price, and then you can take advantage it by doing short selling on a certain counter or even an index itself. Okay, and then for those that are not so aggressive, you can actually look at it by taking a short position to mitigate your potential risk in the market. So for example, a lot of us, we hold shares, okay, and we hold shares for a long time. A lot of, especially the older generation investors, they buy good shares, even good quality shares. In times like that, everything will fall. Whatever it is, even all the solid fundamental stocks, it will drop. Okay, so what happened is that instead of just holding it and then suffer the paper loss, right? What they can do is they can use CFD, because it allows you it gives you the ability to short sell, see. So they can use CFD to short sell the similar counters, or maybe the relevant index to do some hedging instead. Okay, so let's say, for example, I have let's say the tech stocks and all that I'm holding for a long time, Facebook, you know, then Tencent and all that. I think that I want to hold it for a long time and pass it to my son. Okay, but in times like that, all this has been taken a very bad hit. So seeing all the losses on paper and all that, I feel happy. Okay, so then I can use CFD to short sell, like I said, the similar stock, or maybe just short sell the tech counter. Okay, US tech, which is the NASDAQ similar index in the CFD itself. Okay, I can just take a position. Let's say I want to short sell 5 contracts. In this case, my initial margin is 5%. For index contract, most of it, initial margin is 5%, meaning the leverage is up to 20 times. Okay, and then the value for these 5 contracts, okay, is about 66,000 US dollars, because I need 5% in my account. So long I have this amount, 3,003, I can short sell this NASDAQ index, okay, to mitigate my risk in the market. Okay, and when the market really come down, right, you know, the NASDAQ index has been coming down a lot since year to date. Okay, so long I make money from here, CFD, it can help to offset my losses in my cash portfolio. So this is what we meant by hedging. Okay, for those that do not want to take a very aggressive position, it just make a short sell a certain counter itself, but you use it for protection purpose. Okay, in fact, like I said, the essence of this product when it first launched in 1990s, right? Like I said, it's the same mentality by all the savvy investors and institutional investors, because they have very large exposure in the market and they get worried. You know, for professional, one thing, the first thing in mind is that, okay, how to mitigate my risk when something happens. So that's why they have CFD. So now that's why, like I said, with CFD itself, it's very simple, it's flexible, and the thing is, it's also put all the normal individual investors to be on a more level playing field compared to the more savvy one, because nowadays we have these tools that allows you to have different strategies, you know, that we can adopt to protect ourselves from the risk in the market. Okay, and before I go further, like I said, I think the objective today is just to open up everybody's mind that, you know, understanding of the product itself. Okay, I mean, I'm not saying that CFD is suitable and everybody should trade CFD. No, that's not the mentality here. But I think what is important is that everybody should open our mind and understand, okay, how is this CFD works? You know, I mean, it's very common in the market. If I understand how CFD work, then I know whether is it suitable for me or not. That's one. And secondly is that if I have all these tools available, you know, I can, if I think that it's right, I want to leverage on the position to get a better return. Or, you know, when market is crashing, how I protect myself. If I have all these tools available, then I know what can I do? How do I react when crisis come? Okay, so I think this is a very important point to note. And then we must have this understanding. Whether we use it or not, of course, we got to, you know, have a judgment ourselves, you know, based on our risk profile, you know, whether do we know how to, you know, use the, are we for it, this investment tool? Okay, but like I said, most importantly is the understanding of it before you make a decision whether you want to use it or not. Okay, and other than how and what CFD is, I think it's very important to understand, you know, how CFD works in the market. There are many CFD providers in the market. Okay, I'm sure you guys have heard of many names. Okay, but basically it can be categorized into 3 main different providers, different models. Okay, the first one is DMA, which stands for Direct Market Access. Okay, for us, CGS-CIMB, we are direct market access provider. And the second type is market maker. And the third is hybrid, meaning they offer both a bit of DMA, a bit of market making model. Okay, so like I mentioned earlier, we are a direct market access CFD provider. And in fact, we are the largest in the market in terms in the DMA space. Okay, so we have actually increased the number of counters we are offering. So now the last update that I have is actually 18,000 counters across 24 countries. Okay, so what we meant by DMA, direct market access, is that whenever you place an order, right, the order will be sent directly to the exchange. Okay, so the order will be done as a cash equity order, and then it's sent back, and then we convert it into a CFD contract for you. Okay, so the order goes directly to the exchange. There's no intervention from the dealers, and then because there's no intervention, and we do not profit from client's order. Whereby for market maker, what they do is that once clients send in the order, right? So it goes to the trading platform, and the dealers, they will take over. They will have the discretion to see whether they want to hedge the orders in the market or they want to go against the customer. So in this case, what we call Jonga, right? So, I mean, many of you will know, if you trade against a house and all, so the chances of losing most of the time is actually really high, actually. So needless to say, okay. So, and so long, if you trade against a house, most of the time, not only your odds is against you, and there's no transparency, so definitely over long run, it's not going to be good for the customers. That's why everybody in the market, especially if you talk to the big boys, people that are savvy and all that, they will look at DMA. They will want DMA model. Okay, definitely this is the model they want because there's transparency and there's more accountability. So other than that, for DMA models, the orders are done according to price or time priority. It's just like the same as cash equity, just like normal share trading. So you know that, let's say market is doing $10, 10.01, okay, the bid and ask price. And then you queue at $10 to buy. And you know where your queue is because you're queuing right in front. Okay, if somebody's selling at $10, you know that, hey, my queue is there, somebody hit you, you will be done, your order will be filled. It's very transparent. So DMA model is exactly the same. Okay, you will have the price or time priority. But for market maker, that is not the same case. Okay, so for market making model, even if you queue at $10, you know you are there, but they will not show you where you are actually. So let's say you put an order to buy at $10. Market, the bid and offer is still $10, 10.01. Okay, so for market making model, if someone is selling at $10, so even this $10, the bid has been taken up. So now become $9.99, 10.01. Your order may not be done still. Okay, they will not fill your order until it turns offer. So now only by $9.99, $10 offer, then they fill your order. Okay, in this case, you actually lose out one bid already. And sometimes this one bid itself can cost more than your commission. Okay, so these are some of the ways whereby the market makers, they can benefit from the order and then they can make money from the order. Okay, so that's why as if you trade with market makers and all that, this is definitely one of the restrictions that you have, less transparency. And for DMA model, okay, the price and the liquidity that you see is actually identical with what you're seeing from the exchange actually. Okay, so there's full transparency and we don't add additional spread. Okay, and you can participate in the exchange order book. The price, the liquidity is exactly the same as the exchange. But like I said, for market maker may not be the case. Okay, so the liquidity and all that is at their discretion. Okay, so in time, especially in time of volatility, like I mentioned, okay, So it has happened again and again, which we have feedback from clients as well. So even though, you know, some of the market makers, they may be charging lower price and all that for certain reason, but eventually they will still switch back to DMA model because they don't have transparency there. Because let's say for market makers, right, because the liquidity and then for in certain circumstances, you know, even though the price in the market, it didn't hit, let's say the low of the day is $10, but some of the clients' orders can be stopped up at 9.90 something, right? And if the client don't check, you know, they just get stopped up. But there's no recourse to that, okay? Because when you go back to market maker and ask me, how come the market low is $10, but you stop me out at 9.98, for example? So they will tell you that there's no recourse because, you know, it's at their discretion. So that's the reason and the main differences between a market maker and a DMA model. Okay, and for DMA, you are able to participate in the pre and post market options. Okay, for example, Singapore markets open at 9 o'clock, but between 8:55 to 8:59, you know, there will be one matching at any point of time between this timing. Okay, so for DMA client, let's say for CGS-CIMB clients who participate in this CFD trading, you are able to participate in this pre and post market option. Okay, but for market maker, that is not the case. Let's say, for example, Singapore market open at 9, from 9:01 onwards, then only you can place an order. Okay, so I'm not sure whether you are aware, actually, some of this matching session is actually golden trading opportunity period. You know, for example, let's say from my observation, is for Singapore context, the matching session sometimes present a lot of trading opportunities, especially during month end or even quarterly end, whereby a lot of fund managers, they will do window dressing and all that. Okay, so it's important, if you're an active trader and all that, you definitely want to have the opportunity to take advantage during this trading period. But like I said, for market maker, 9:01, then you can place order, and market close at 5. By 4:59, they don't allow you to place order anymore. Okay, but for DMA, that's not the case. Market close at 5. After that, you still can participate in the matching, just like the underlying exchange. Okay, so everything will be the same as the underlying exchange. And then for CGS-CIMB, right, Singapore, we offer CFD trading, but we have 2 different platforms. Okay, so just to make it clear to everybody, okay, so we have ProsperUs. Okay, I'm sure many of you have seen this branding for a long time already. So this platform is actually set up in 2020. Okay, and this is a platform for millennials, designed and designed and offered by the millennials as well. Okay, so this is actually quite a savvy and smart digital platform for trading. But for ProsperUs, you can trade multi assets. So you can even trade cash market, you can trade CFD and other products as well. Okay, and then you can also trade CFD under CGS-CIMB CFD. Okay, so the CFD department itself, we also offer CFD trading. Okay, so the platform used are different for 2 different departments. Okay, so I mean, because I'm from the CFD department, so I think today a lot of context will be covered under the CFD department. Okay, and but like I said, not to worry, because both platforms offer multi-asset trading. Okay, so when you want to after you decide which platform you want to adopt, make sure you check, you know, exactly what product you're looking for, and then also the specification of the product you're trading in terms of cost, in terms of markets, in terms of all other details. Okay, so let's say for CFD product that's under the CFD department, okay, the product suite is a lot more, you know, in terms of market, in terms of products that we are offering. But under the CFD front, okay, you can trade multi-assets, okay, in the same account, but all under CFD product itself. Okay, so for example, for the CFD department, okay, you can trade CFD on all these different instruments, which is equities, FX, index, futures, and even bonds. Okay, so but all this will be in the CFD format. Okay, so for CFD itself, the equities, we offer more than 24 exchanges, more than 18,000 counters, and like I said earlier, for shares itself, it's up to 10 times leverage. But for FX, for index and all that, the leverage is up to 20 times. Okay. And these are the markets that we're offering under the CFD department. Okay. So like you can see, a lot of countries, even like we have access even China through the Hong Kong Shanghai Connect. Okay. US itself has got a lot of counters to trade. Even on the short side, there are thousands of counters for short sell availability. And for shares itself, like I said, even you trade under CFD, but it's very similar to traditional cash trading. How you trade is exactly the same. Okay, so therefore, when you buy a shares or you hold a position in CFD, you are entitled for the corporate action as well. Okay, because when you buy shares, a lot of time company that do well, they will give dividends. For CFD, it's the same. You are entitled for all corporate actions. Let's say rights issues, bonus issues, dividends, stock splits, and all that. You are entitled to it. So, for example, if the shares are giving out dividend, okay, Singapore stocks recently, a lot of stocks are come dividend now. So by next 1-2 months, April, May, a lot of companies, blue chips are giving out dividend. So if you're holding long position, okay, on the X date itself, the dividend amount will be credited into your CFD account. Okay, on the X date. You don't have to wait till payment date. Okay, unlike traditional cash trading account, you got to wait till payment date. But for CFD, you will get, if you're holding long position, it will be credited into your CFD account on X date. But for short position, of course, the reverse will happen. So the dividend will be debited from your account on the X date itself. Okay. So for other corporate actions, that it will reflect accordingly in the CFD account as well. But one thing to take note, like I said from the beginning of the session, I already mentioned, you trade CFD, you trade on the underlying movement of the price, correct? But actually, you do not own the underlying position. So therefore, meaning you have the position, but the shares is not under your name. You don't own the shares itself. You have the position. So therefore, you do not have voting right. Okay, so this is the main difference compared to normal share trading. So therefore, you can't go to an AGM for lunches anymore, even though now it's not common. I mean, people don't do lunch anymore because of COVID. Okay. And other factors I think is very important, in order to have an edge in the market. Okay, so like a lot of savvy traders and all that, you definitely want to treat trading like a business. Okay, so therefore that says you must have proper risk management and risk reward analysis. So I mean, a lot of individual investors and all that, I think the ratios is pretty high, whereby they say 91% of the retail investors lose money. I think mostly it's because definitely they don't have a proper trading strategy, right? A lot of people, they are probably too lazy to do, homework, have a really workable trading plan kind of thing and stick by it. All these are hard work, in fact. That's why for us, we always provide a lot of classes, a lot of all these value add webinars to clients, so that they are keeping abreast with what's happening in the market, so they know what is the sentiment in the market and all that, so they can trade, that at least they can have a better view of the market and do a proper analysis before they take a trade on anything. So for investors, for traders and all that, they must ensure they have proper risk management and all that. So other than, what they need to put in terms of hard work and all that, I think platform is very important. So therefore, with CFD platform that we have and all that, I think speed and stability, all that, at least definitely this is very important. And this is what we can offer. As you can see, the platform they're offering by the CFD department and also ProsperUs is actually on cutting edge. And then it's actually very smart and highly customizable. Okay. And then also you can use some of these features in the platform itself to ensure that, you have proper risk management control. Okay. So even though, yes, you may have done a lot of homework, research, you think that you have high conviction that this price might go up. That's why you want to buy, you want to hold a long position on it. But sometimes, things just don't turn out the way we expected. So then now, in this case, you've got to have the ability to put in stop loss, OCO, which is one cancel another, different kind of contingent order, just in case market goes the wrong way, you are able to stop yourself out. Okay, I think a lot of people feel that trading CFD itself might be risky. Okay, so because like you mentioned, it's highly leveraged. Okay, but also I think the mentality is very important. Okay, because if you look at the market itself, many of the traders, investors and all that. So why retail, most of the retailers that lose money is because they just follow the herd, right? If the market, the sentiment feels that, oh, it's very bullish, everybody's buying, so I just want to jump in and take a punt as well. Okay, but when it goes down, oh, what happened to the market? I'm so fearful, and then I just cut everything. So therefore, it doesn't work. It's the mentality that caused all these unnecessary losses. But for savvy investors and all that, they will have the proper mindset, and therefore, regardless of whether they are trading on cash position or leverage or even derivatives and all that, so long you have proper plan, the chances of winning is at least higher. Because a lot of retail investors, I used to share this story. A client of mine actually shared his statement with me before. He solely trade on cash account, okay? And then he has been buying a lot of stocks and holding for many years. But over these years, many of his stocks actually turned into penny stocks, and then he has gone through many sort of consolidations and all that. So basically, he put in hundreds of thousands into picking up the shares. But end of day, he only left with a balance of few $1,000 when he looked at the CDP statement. Okay, so in this case, he lost almost like 98-99% of his investment. But to him, is that so long I don't cut, I don't cut, I don't realize my loss. Okay, but that is definitely a wrong mentality. Okay, in fact, in that case, he lost 98-99% of it. Basically, it's gone. But whereas people that are using CFD, for example, because they trade on margin, okay? So when you trade on margin, if the market don't go your way, you will have unrealized loss, okay? And in that case, your margin will eat up, and then you do not have enough money in your account. You'll be called to top up your account. That's what we call margin call, okay? So when you are asked to top up your account, then probably it will hit you that, hey, actually I've made a wrong decision. I should probably, cut my position. So therefore, all these stop losses and all that comes in. Okay. So in a way, having this right mindset and then using leverage product and all that, it may help in a certain way to manage the risk, rather than a lot of people have the same mindset. Okay, I don't use leverage means no risk. No, not true. Okay, the right mindset with the proper risk management is utmost important, in fact. Okay, so this is a view of our platform, the desktop version on Viewpoint that is provided under the CFD department site. Okay, the ProsperUs, they will have a different platform. Okay, also, is very nice, very easy to use, and also highly customizable as well. Okay, so I think if you have interest, you can approach the different departments for more understanding. So I think for both CFD and also ProsperUs department, we both provide all sorts of training and tutorials to guide clients how to use the platform, understanding the features and all that as well. So of course, mobile platform is available. And other than that, I think trading costs, just like running a business, okay, the cost itself is definitely important, right? In CFD itself, very importantly, you got to understand there will be two costs involved. So one is commission, okay, and then the second one is financing charges. Commission, of course, when you buy and sell, there will be commission incurred. But normally, if you compare CFD and traditional cash trading account, the commission rate, the cost is definitely much competitive in the CFD space compared to the cash trading. And for financing, these charges will only kick in when you hold the position overnight. Okay, so let's say if you buy and sell within the day, there's no financing payment. So how do we calculate financing charges? So let's say, giving you one example here, if I'm buying, 10,000 shares at $1, which is $10,000 worth of contract, okay, and I hold it for 5 days. So the contract value, you times the financing rate. So for the CFD department, the financing rate is, the standard financing rate is 3.75% plus the base rate, okay? So the base rate itself depends on which market you trade actually. So different market has got different base rate. So for example, for Singapore will be the 1 month SORA rate, and then for other markets will be, let's say for US will be the US overnight financing rate and so on and so forth. So you can refer to these rates on the website itself, okay? So let's say the base rate for Singapore market, because this example is Singapore stock, is 0.25%. Okay. So 3.75% plus 0.25, that is about 4% per annum. Okay. And then times the contract value. And then because I hold it for 5 days, okay, you divide by 365, and then because I hold it for 5 days, so the long position financing, I'm going to pay $5.48. But for short position, you will take the 3.75%, the standard financing rate, minus the base rate instead. So the same thing, let's say I use the same 0.25%. So the estimate annual financing for short position is 3.5%. Again, you times the contract value, and because I hold it for 5 days, so times up 5 days, I'm going to pay $4.80 for holding this position for 5 days. Okay. And again, like I said, if I buy and sell within the day, there's no financing charges. Okay. So that's the flexible thing about CFD. And we do not charge hidden costs actually. So there's no inactivity fee. A lot of broking house, especially the market making company and all that, they will have all these charges. So therefore, regardless of which broking house or provider that you approach, you must always ensure that you check on all these specifications before you start the trading journey. Okay, so but at least for the CFD department, we do not have inactivity fee, and then there's no custodian charges and all that. And other than that, we also do not do auto conversion. So basically, what it means is, let's say you put in a Sing dollar in your account, okay? And then you want to buy US shares, you want to buy Hong Kong shares and all that. In cash market itself, normally what happens is that, let's say I want to buy Facebook. When I want to pick up my shares, I need to convert my money to US dollar to pick up. And after I sell it, my proceed, I'm going to convert back to Sing dollar. So I will have this conversion taken place, and then, I may lose out in exchanges, the exchange rate, the slippages. But for CFD account itself, You don't have to because it's a multi-currency account. So if you put in Sing dollar in your account, okay, and then you want to buy Facebook in US, we do not convert your fund into US dollars. There's no need to. Okay, your money can remain in Sing dollars. And then so long when you want to open your Facebook position, the initial margin, let's say, is 5,000 US dollars. So long you have sufficient equivalent amount, okay, based on the indicative exchange rate, you can open the position already. Okay, so you don't have to convert your money every time you trade. And then after you close the position, your P&L from the Facebook position will remain in US dollars. Okay, so now you will have your Sing dollar remain in Sing dollars still, and then you have the P&L in US dollars. Okay, so then you can continue to move on from that. Because what if the next day, you want to trade, let's say, Berkshire again, okay, US stocks, and now, you make a loss of $1,000. So at least you don't have to keep converting. You can take from your profit from your US dollar earlier to offset it. Okay, it gives you a lot of flexibility. And like I said, when you don't have to auto convert every time you trade, you save a lot of money. Okay, and this is one way how market makers, they make money as well. Okay, a very big chunk of it. And when you look at trading costs, ultimately you will want to know, how the orders are being executed. All these are money and cents. Okay, so because let me give you an example. I'm sure you guys have heard of Robinhood. Okay, this is an article back in August 2020. They make tons of money. Okay, because you all know that in US actually it's allowed. The US brokers and all that, they can actually sell your orders, to get rebates and all that. So that is one way how they make money. But of course, sometimes it may not be advantageous for the clients. Okay, so therefore, so a lot of people will prefer the DMA way, whereby every orders is straight through to the exchange and all that. So because there's no intervention and things like that. And because for a lot of other providers, I'm not just talking about Robinhood, I'm talking about other CFD providers. Okay, they have either they can profit from the orders, right? Remember, they can take an order against you. They can take a bet against you, or they can actually make from the bids and offer before they hedge your position kind of thing. So they can also profit from that. And or probably they can make from the auto conversion every time you place a trade. All these actually enable them to charge a lower commission or rates in the market. So therefore you will probably ask me, okay, I mean, you have talked about the advantages of DMA and all that, but why people still trade with market maker? So this is the reason why. Because market maker, most of the time, like I said, they don't place the order into the market, correct? So then they don't have to incur all these market charges and all. Okay, they can save off all these charges, whereby we, DMA, every order go into the exchange. So all these fixed costs are there. Okay, you can't run away from it. You want the transparency, you want the liquidity from the exchange, you have to pay the exchange cost. Okay, so these are the market charges that definitely got to incur for the DMA route. Okay, so therefore, ultimately, a lot of people, they probably still trade with market maker is because they look at just commission itself. Oh, market maker, they're charging me a lower commission, so I just go with that. But without understanding that actually behind the scene, there are a lot of ways they can make money from you, which ultimately put you in a more disadvantageous position. Okay, so therefore, like I said, you look at the big boys, you look at the savvy investors and all that, they will definitely go for DMA model if liquidity is important to them, transparency is important to them, all this is important. So like I said, for a business to work, I mean, it really depends on what sort of strategies you have, your size, your risk appetite and all that. Then you will want to ensure that you choose the right model to run your business, looking at the cost and all the different factors and all that. So there's also this Chinese saying, they say, 羊毛出自羊身上. Okay, nothing is free there's no free lunches, correct? So if somebody tell you that mine compared to everybody else, mine is free or really, really cheap, there must be a reason to, okay? Because a successful business can run on no cost, okay? And of course, for your trading, for your investing journey to be successful, you need to have a good partner. Okay, broker credibility definitely is important. Okay, I'm sure you guys have read the news. Recently, there were some foreign FX providers and all that. They were called for investigations and all that because of certain issues and all. So, and definitely for your assurance, you are pretty safe with CGS-CIMB because, we are SGS trading member and we are regulated by MAS. And in accordance with the SFL rule, clients' money, retail clients' money are actually parked in a segregated account. It doesn't commingle with, the company's fund and all that. So, and looking at the credential itself, you can see from the website, you can read up on the company info and all that. We have won a lot of awards actually. Okay, so I will not go into details on all that. This is just last year alone, we can see all these awards. So, like I said, if you have questions, just let me know. Today's session, like I said, is hopefully to answer all the questions that you may have, if I can. Okay, and then throw in any questions you want. If you have any questions, do give us a call, drop us an email. We will get back to you ASAP. Okay, I think I'm quite done with my presentation. Crystal?
Thanks, Leries. Thank you for the amazing presentation and also the basics of like CFDs for investors who are not really very familiar on CFDs. So I believe we have a few questions from the floor. Let's take a look at the first one. If the CFD I'm trading, its underlying asset is suspended or halted, can I sell the CFD or whether I will suffer losses?
So this is a good question and it's a very common question that we always get. Okay, so definitely the answer is yes. So basically how we work is because we are DMA, okay? So how you trade it is exactly as the same underlying. If the shares get halted or suspended, on the CFD front, you will not be able to trade out of your position as well because the shares itself is not tradable. Okay, so in this case, if you're holding a CFD position, then in a way you can't do anything at all as well until the shares resume. So in this case, it's actually pretty rare that we see these instances, okay? Because, not many countries will just go suspended like that. But in the history, yes, we did see some examples, for example, Bashful and all that. It has been suspended for quite a while because of certain regulatory issues and all that. So the answer is yes, it's very rare, but if it happened, yes, you will be held on to the position until the underlying shares resume trading again. Okay, so unless at a later stage when this company, they said they will delist or probably a takeover, whatever, privatize, then it depends on the underlying position, and then your CFD position can react accordingly, the same as the underlying position. Okay.
Okay, thanks, Leries. Let's take a look at the next question. When stock price goes against my position, can I pick up that stock and keep in my stock portfolio?
Okay, so for CFD, the answer is no. Okay, so basically you're not trading the underlying shares. So you hold a position in the CFD itself. So even if the share price goes down, right, you need to just close it, buy it back. You're holding a long position, right? So you're just going to sell it and then take the loss and close the position. You can't convert it into a cash position.
Thanks, Leries. I think we have 2 more questions, right? Let's take a look. What if my losses is more than the initial margin I've invested? Should I wait or sell, taking in the fact that I still have enough to maintain the position?
Okay, so what happened is when you have a CFD account, okay, if you look at it, you will see that in the account itself, you will require the amount, initial margin to initiate your position, right? But other than that, you will also have another column to show you what is your free equity in the account. Okay, so basically, let's say I give you an example. I have $10,000 in my CFD account. Okay, and I take a position of let's say I buy DBS Bank. Okay, I buy 100,000 worth of position because it's margin at 10%. Okay, so I want to take 100,000 worth of position. Require initial margin of 10,000. So basically, I have enough. So I initiate the position. But once I initiate this position, my free equity, meaning the extra fund in my account now is 0. Okay, my initial margin 10,000, my free equity is 0. Okay, because I max out my money in my account to buy this position. So long DBS price goes down, okay, then I will have an unrealized loss, correct? So let's say it goes down by $1,000, okay, then my free equity now will be a negative, okay, because it factored in your unrealized loss. So long your free equity goes negative, you will be asked to top up your account, so-called margin call. Okay, so depends on how much is the unrealized loss amount, you know, and all. The free equity will show you how much. So long you need to bring it back up to positive, then you're out of call. So for your question earlier, so when you have a loss more than your initial margin and all that, normally you will not be able to wait till then and do nothing at all, because if you do not have enough free equity in your account, you will be asked to top up your account already. Okay, so maybe when you are asked to do a margin call and all, then you will see you will have to make a decision whether you want to cut your position or you want to top up more to maintain the position.
Thanks, Leries. Moving on to the next question. Can I use my asset in my stock portfolio as initial margin?
Okay, so I think it's a very good question. It shows that you guys are actually, you know, have experience in trading all this thing. Okay, but so for CGS-CIMB, I'll go a little bit deeper into it. So for CGS-CIMB, you know, we actually has a lot of different sort of customers. Okay, so we have the retail business. We have a lot of retail clients, you know, that trade CFDs and all that. And we also do B2B business, or even, you know, another part of it will be all the high net worth clients and all that. So what happened is that for this B2B kind of relationship, the business and all that, we do have bespoke solution whereby we can actually use the equity to be part of collateral, you know, to have a wholesome kind of CFD solution. Okay, but that is, like I said, is a very special segment kind of clients that can have a bespoke CFD solution. So the answer to you is not a no, okay, but like I said, this is a separate matter. So like I said, for this kind of clients, you know, you may approach us and then we can have a, you know, offline discussion. But as a general rule, okay, CFD, the plain CFD itself is very simple. Basically, we do not take in shares or equities to be collateral. Okay, you're going to put in cash to trade CFDs. Okay, I hope I answered to your question. Like I said, we can do, but in general CFD, we only take in cash for trading.
Thanks, Leries. Okay, the next question is, what's the difference between CFD and option? Which is a better way to hedge?
Okay, so well, I think to answer your question, my view is that which product do you understand most? Do you really understand and feel comfortable trading it? Okay, so for me, I know a bit of option, okay, but really dealing in it, I'm not comfortable because I'm not really understanding deep enough as in what are the components in it in terms of course they have you know they have the alpha, beta, and all the different calculation, and then they also have time decay, you know, as is nearer to the expiry date, you know, then my value will depreciate, you know, and I mean I don't have deep enough understanding of how the option works, even though generally I know yes you have the obligation to buy, but that is not good enough for me to use it as having an edge in the market. Okay, so I think this may be a question back to yourself, whereby which product you understand most. So for me, I understand CFD very well. It's very simple. You know, you don't have to, basically when you buy in the position, let's say index and also an equity position and all that, there's no expiry. Okay, so you can hold it technically as long as you want, right? So long you have sufficient margin and all that. Of course, financing charges applies. Okay, so then I think when it goes up, I take profit. When it goes down, you know, if I short, I take profit, or if not, I cut loss kind of thing. It's very simple for me. I know what I'm doing and I have more confidence in dealing in this product itself. But for option, not really. So the thing is, if you are expert in options, then of course it's a different matter. We see people that make money from options. We also see people lose a lot of money in options. Okay, so ultimately it's what you're comfortable with and what you really understand in order to have an edge in the market. Okay, so to me, definitely CFD is way more simpler and more transparent and direct as a trading tool, you know, to be used in the market. And it's very flexible in terms of liquidity, everything, it's just there, you know.
Thanks, Leries. I believe we have one last question for tonight. As a new investor looking to give CFD a try, do you have a recommendation of what percentage of my portfolio should I trade in CFDs?
As a new investor looking to give, okay. So I think, as we always learn from all the trading gurus and all that, you know, they always advise, be it using CFDs, being trading in the cash market or any product, okay, the money that you put out for investment is the money that you can afford to lose. Okay, so I think that is the first principle. So, and let's say if you can afford 10,000, you know, that is a capital. And in order to make sure that you don't lose the 10,000, I'm sure you want to then put in effort to understand the product. Okay, and you know, to start learning first, and then make sure that you know how to put in some stop loss. You know, what are the costs involved if I place this trade? You know, what is the implication if I hold it for, you know, a long period of time, kind of thing. So you got to understand. Okay, so long you have this kind of understanding, that at least the probability of not losing the money is higher. But like I said, first of all, that is the money you can afford to lose. Okay, and second thing is back to CFD itself. Okay, in terms of how much and all that, it really up to individual. You have to decide. But ultimately, how much you want to use in CFD itself, it also depends on what you're trading. Okay, so let's say, for example, if earlier I was talking about you know, C Limited, DBS Bank, you know, all this good company, blue chips and all that. So, you know, the volatility of these companies, the 10% move, a 20% move, it's already very scary. And it's not common to have a 50%, 70% volatility company. So at least, you know, if I want to put in 10,000 worth, you know, if the share price volatility is normally about 20%, I only use my capital, you know, to hold a position up to maybe 50, 60%. So even though the price move, I'm still fine. Okay. So for example, back to the example I gave you earlier, if I have 10,000, okay, I buy max up, I buy max up to 100,000 worth of DBS. So leave free equity to be 0. So even tiny movement, I got to top up. But in this case, if I have 100,000, okay, my risk appetite is not that high. I only want to buy 10,000 worth of DBS. So my 10,000 capital, in order to buy 10,000 worth of DBS, I need 10%, right? Which is 1,000 as initial margin. In this case, my free equity is still 9,000. So even though DBS price moved down a lot, I'm still safe because I have a lot of buffer in terms of free equity. Okay, so if you are more conservative and then you want to start small first, maybe start with, a shares. You got to determine what sort of volatility. And then based on the volatility itself, you give yourself a bit more buffer so that you don't, get knocked up. As in what I'm saying is like stop out when the price, go too deep down, when market like that happen.
Thanks, Leries. Thanks for sharing with us on CFDs tonight. So do remember to actually do some homework before you actually start trading or investing. We hope you enjoyed today's session and managed to acquire some key takeaways. So to help us better understand what we can do for you better in future sessions, do kindly help us to complete this survey. You can also scan the QR code shown in the Zoom screen. Thank you so much. Thanks, Leries, and thanks, everyone.
Thank you, everybody. Good night.
Bye.